Um, Sunil, I'm admitting all participants now. We can start in a minute.
Are we good to go?
Yes, we can begin.
Good evening and welcome to our next edition of the presentation on the economy markets and our ongoing NFO, which is the Sundaram Bluechip Fund. I'm sharing my screen with you, and as you can see there, size matters is the code of our fund, and this is going to be an open-ended equity scheme investing in large cap stock. It's a diversified portfolio, and the image of a sumo wrestler is our brand image for this fund. I shall explain the logic behind it at the end of my presentation. So, what are the characteristics of large caps? Right. So, large caps are defined by SEBI as the top 100 companies by market cap in India. Right. So, they carry the following non-stock market related features, which are proven business models, size. Their size obviously matters both in terms of scale and in terms of the competitive advantage it gives them. They get stability across business cycles, and they have wide and deep management bandwidth. Unlike smaller cap companies which are dependent on the owner or the owner's family, they have much more wider depth, and they also have strong balance sheets, which help them to acquire good quality people as well as growth through M&A, buying out companies. And then when you come to the stock market, right, there's high liquidity in these stocks, and the universe is well researched. So there are absence of too many surprises in terms of what happens with those companies, right? So as we move forward, right, like I mentioned earlier to you, this is a diversified portfolio. So it will have about 45 to 50 stocks. Now within large cap, there are concentrated large cap funds which are limited to 30 stocks, and there are diversified which have 45 to 50 stocks. This features in the diversified list. Hence, its benchmark is the NSE 100 because you have a wider range of 100 stocks from which to choose from for most of the portfolio. Regulations permit a max of 20% on mid-cap stocks. And on the portfolio construction, I shall talk to it a bit later. Right now, at this point in time, what I thought is that since we are presenting a large cap fund to you, you should spend a little bit of time thinking about what happens across large, mid, and small. When should you allocate more to large cap? When do you allocate more to small cap? So let's look at the past track record. And when you look at the returns as of last month end, you can see that the large cap, mid cap, small cap index from 1 month up to 1 year, right, have all returned positive returns, and the trend is that the small cap seems to have done better than mid cap better than large cap. So you must be wondering, if they are giving the better returns, why is Sundaram not in a large cap? This is the right time for large cap. So to that point of view, I'll say take yourself back 4 months back to 31st of March, right? The same 1 year return, which today is 6, 12, and 16 and a half, was then minus 0.5, which is almost flat for large caps, minus 25 for mid cap, and minus 33 for small cap. So it was a very different picture just 4 months ago. And 3 months prior to that, prior to the COVID crisis, you saw large caps actually delivered a 14.5% positive, whereas both mid and small were negative. So in the space of 9 months, you've seen a bewildering variance in terms of a profit versus losses. Second, in terms of who is the leadership in the cap curve. So what explains this, right? So what is this? That this is just over 9 months. Let's look at it over a longer period, because you're not making investments for 9 months, you're making investments for 3 to 5 years at least, right? So to understand this, there's a methodology analysis called rolling returns methodology. This is nothing but taking, suppose you have a 3-year outlook. It's taking 3-year returns every day for a long period of time. So get enough 3-year returns to make a judgment call on, in 3 years, is a large cap better, mid cap better, small cap better, or does it vary across time? Right? So in our analysis, we have taken a 16-year period starting from January 2004 up to August now. So in these 16 and a half years, you have 4,992 3-year periods observation, right? So you have a solid base to make a judgment call. And over 5-year returns, if you want to look at, there are 4,200 observations. And if you want to evaluate 10-year returns, you have 2,500. So you have a large base of observations. So whatever conclusions we drive, because I'm going to use this a lot in the course of this evening, you can feel that it's reliable and it comes across good times and bad times, because over a 16-year period, you know, there have been good times and there have been bad times. So what can you see here? You can see here that the average returns Whether you choose large, mid, or small, have been by and large in the early double digit, 12 to 14%, right? Maybe 10 if you go slightly longer. So there's not really much difference in average returns. But let me tell you that when you read down there, right, these are misleading. Why? Because nobody ever gets the average return. You take the Ganga River at Haridwar, it has got a certain depth. At Rishikesh, it has a certain depth. On an average, you will say Ganga is 3 feet deep and you can't walk across. Because you don't know at that particular point, is it 3 feet or 20 feet? So that's the point being that similarly, if you want to get a sense of your returns, you cannot take the average and say, this is what I'll get average over time. So I just gave these to demonstrate the misleading nature of averages. And so the degree that this varies around the average is known as volatility or risk or standard deviation, multiple names for it, but all of them mean one thing, that is they give you a different returns depending on when you invested. So when you now look at it and say, okay, in a 3 years, what did I get maximum? Or in a 5 years, what did I get maximum? And what did I get minimum? That is, if there is a loss, what is the minimum maximum? Loss I suffered. So there you can see very clearly. Let's discuss the 3-year periods. Over almost 5,000 observations, we saw that when the timing was good, large caps gave you 48% per annum. Mid caps gave roughly the same, but small caps give you 70% per annum. So clearly, while an average was roughly the same, you can see the maximum return you got from small cap was 22% per annum better than a mid cap. And you say, how great, then I should always invest in small cap. No, the point is there is variability. So when you suffered a loss, you lost 8% is the max loss you faced per annum on a large cap index, but you lost to 21% per annum in a small cap index. So can you see that the high returns comes with high risk of loss? So that's what I say, that when you look down, you'll see that clearly large caps give you better protection in bad times, but not as much return as mid and small cap in good times. So then, as you can now figure out, in your investment, you've got to make a judgment of is the times going to be good or the times going to be bad. So to put this into perspective, so what this means is that overall in the asset allocation, this is a risk reward line. There's low return to high return on the y-axis, and there's low risk to high risk on the x-axis. And as you can see, large caps in the median of that, which means that they are riskier than debt funds, but within the equity, they are the safest asset class, right? In terms of the risk return framework. So now we come back to our question, large, mid, and small. What are the basis for deciding? As just first line I've repeated. So what you need to do is to try and get your good times, bad times prediction right. Then you can make the perfect switch from large, mid to small, minimize your losses. You can't add just 5,000 motorcycle capacity for this year. Then the following year, add another 10,000 and then add another 10,000. It doesn't work that way because you need to acquire land, building, plant, machinery, borrow money for it, set it up. So you set up for 50,000 motorcycles. So what happens then is that you set up 50,000. So this year's 95% capacity utilization next year goes to 105 divided by 150. So that's what, roughly 70% capacity. So straight away the capacity has dropped dramatically. Why is this important? Because this affects GDP, it affects profits. Because when demand is more than supply, the consumer is at the mercy of the supplier. So the price is set by the supplier, the producer, the manufacturer, whatever. But when supply exceeds demand, the pricing shifts to the consumer because he has lots of choice. So this affects the profitability of companies and the economy. So that's where you have cycles, and all that I have described, now I'm putting it graphically. So the bottom half, so the first of all, the left-hand side circle is the virtuous cycle. That's a good cycle. The right-hand side is a vicious circle or a bad cycle. So the bottom half is what I just explained, right? When a good cycle, there's high demand. This demand is greater than supply. So the profitability of companies is high because they set the price. Their capacity utilization improves as the sales goes up. So they reach their peak capacity, they put higher investment and they produce more goods, which then brings down the inflation, the interest rates. And when interest rates come down, it makes it easier to buy more cars, more auto, right? Because you get cheaper EMI. So that's the good cycle in circulation. And suddenly these good cycles turn bad because generally demand collapses due to a crisis, global financial crisis, coronavirus crisis, whatever. The demand collapses. So the capacity utilization comes down, no further investment on any capacity creation. So supply becomes tight, inflation goes high, interest rates goes high, further depresses demand. So this is the classic way that you get a cyclicality in the economy. And in the Indian economy, this cyclicality leads to cyclicality in the stock market, right? Why is that? Because stock market gives you returns how? Through EPS and through valuations. So EPS goes through the cyclicality because in a good cycle, EPS goes up. In a bad cycle, EPS comes down. Then on valuation, valuation is in turn decided by two things, right? Because the PE goes up, you make money. PE goes down, you lose money. That is what is called re-rating. When you now look at it, how does the PE go up or down? Two things. If future expected earnings, that was current earnings, right? Future expected earnings goes up, then your PE goes up because you think that there's going to be more money at stake. Next, demand for stocks. Demand comes from FIIs, from domestic mutual funds, from retail traders, from LIC, from other insurance companies. A lot of buyers are there. So when demand goes up, prices go up, right? So that's again the P ratio. So these two are also cyclical because the current EPS fall, if you unless you're at the edge of a vicious virtuous cycle, it means that future EPS also is going to be bad. Same way, the flows, what happens? Flows, there are two different things for you to remember, which I shall point out a bit later in terms of the fact that flows affect large caps and mid and small caps differently in down cycles and in up cycles. I will come to that in a little bit. But like I said, what I just said now, business cycle impact all the three of these, and hence your EPS fluctuation and the fluctuations lead to the stock market cyclicality, which is what I've demonstrated here. For your information, we started from April 2003 to today. So over the last 17 years, you have seen 4 cycles in the Indian economy. The 2003 to 8 was a boom time, good cycle. Then 8 to 13, the global financial crisis, subprime crisis, bad times started. When did they end? When Mr. Manmohan Singh, towards the last term, last 6 months, announced the reforms package and kick-started the next virtuous cycle, which was when Mr. Modi came to power. And for the next 3 to 4 years, you had a good cycle. And in December 17, you had a confluence of events. You had negative food inflation, then you had demonetization's impact coming through, you had the GST implementation, and you also had the NBFC crisis. So all of these put together put the Indian economy back on a slowdown into a new vicious cycle. So you can see over the last 17 years, economy has seen 4 cycles. Now in this stock market that I have described, you can see there are 3 lines: mid cap, small cap, large cap indices. I'll discuss them in detail in just a bit. But right now you look at it, the trend is in a good cycle, the markets all rise. In a bad cycle, the markets all fall. Markets rise, markets fall. So the stock market cyclicality follows the economic cyclicality. Now, what does that mean in terms of numbers? So what I've done is the 2 virtuous cycles I've put on the left side of your screen and the 2 vicious bad cycles on the right side of the screen. So if you look at the virtuous cycles, what do you read there? First, it's all green, which means that all the stock market indices deliver positive returns in good cycles, right? That's number 1. But number 2, look at the trend line. Small cap does better than mid cap does better than large cap. These are all annualized returns, right? So 77, 63, 49. The same trend is followed in the next virtuous cycle. So in a good cycle, small caps do better than mid caps do better than large caps. But in a bad cycle, it's reversed. You see that both mid and small cap indexes deliver deep negative returns of 8 to 13% per annum, whereas the large cap in the first vicious cycle was flat. In the second vicious cycle, actually gave you 5% positive returns, right? So this is what I have summarized there. So if you get the business cycle prediction right, you can switch from large to mid to small, minimize losses, maximize returns. So before you do your asset allocation, it's important to understand the stage the economy is in the business cycle. Right now, one small point here, I said I will explain to you later. Why is it that the large caps alone are able to be flat? Right? You would have expected that they'll have a slightly lesser negative. Right? If economy is bad, everything is bad. That's because when you go back to the previous slide, when I talked about the valuations in this, EPS goes down even for large cap companies. Expectation of future EPS also goes down, but They tend to recover faster than mid and small cap in a bad cycle, number one. Number two, you actually see paradoxically more money flow into large caps during a down cycle. Now, what is the answer for this? The reason for that is that abroad in developed markets, when they experience negative growth, their governments and their central banks print money and put it. And there is exchange convertibility and there is no color for money there. So the money which they print to get their economy back up and running, the stock market participants, the hedge funds, take that money because rate cuts also come with that. So it's cheap money, a lot of money. They take it and they put it where they think they get the highest return, right? And that's where they are betting that the large caps rising ahead in countries like India, which are fast growth countries generally, the money actually in a bad cycle, instead of going to their economy, comes to our stock market. And that's what gives these large caps a defensive nature of giving positive returns in a negative, vicious cycle. So that's the point about large caps that I'd like to make at this point. And as we now move forward, you can see that this other reason for this is that whenever you have these cycles and you have large cap, mid cap, small cap, there are a lot of multi-baggers. But the point is that I wanted to tell you is that in the bad cycle in the middle, right? Also, large caps have got multi-baggers, mid caps and small cap also have. These are number of companies. But these multi-baggers is what makes the fund managers also deliver to you decent returns, even in bad cycles or in good cycles, right? So with that being said, now it's time then to decide on the large, mid, and small allocations to look at the update on our current outlook. I just mentioned to you that we are in a downtrend, so let me start off with that. This downtrend, you saw December 17, the stock market's downtrend, the economy's downtrend also started December 17. So this is services industry plus agriculture, the total of the GVA or equal to the GDP, you see the downward trend, right? So our economy, much before the COVID crisis, much before the lockdown, has been on a slowdown, right? And on top of it, in quarter one, we saw that the impact of the pandemic plus the COVID crisis led to a 24% negative GDP growth, by far the worst in comparison with the G7 countries. This growth was shared equally by industry and services being 38% down. Agriculture came with the saving race with a 3% positive, right? Now, this clearly then tells you that we are still in the midst of a vicious cycle, right? So, in that sense, the economy naturally leads to cyclical in the stock market. So, first thing is that in the chart we saw, right? Current earnings, future earnings, demand. Let's look at all the three. So, you see the current earnings in that quarter, the 23% negative GDP growth led to an overall market's 28% negative sales growth and a 51% overall market's profit drop. And 71 if you take away the banks, which had a good time because they got cheap money and they didn't face NPAs because moratoriums were there. So the take away the banks, the market earnings are down 71%. So that indicates the earnings has not been great. But if you break it up into large caps, mid caps, small caps, and micro caps, you can see that the more the pain is in the smaller end of the market. So micro caps are down 500% in terms of their earnings growth. Small caps are down about 79 if you take it with the banks. Mid caps and large caps are at 58 and 55. So you can see that another reason that large caps get affected less is that earnings gets affected less even in the severest downturn. Yes, it is very bad, but not comparable to the level at which small caps are down, right? So based on this, you can say the immediate outing also is still weak, right? So now you see that I just explained to you, large caps are less affected because in all the three parameters, they get less affected than mid and small caps, right? And when I talked about the flows, I told you that the flows come in. See, even in this bad time, April to now, we have had $11 billion come into our market with FIIs, which is 83,000 crores. And to the extent that the domestic fund managers sold 17,000 crores, they more than compensated sell. That is why the large caps will be rising, right? Then you see that hence in this down cycle, large caps have delivered 5% positive returns, as well as mid cap and small cap are negative. So this way forward now, how long is this vicious cycling to continue? If so, for how long? So that you have to look at it this way, right? there is some positive in this 23% negative. First is that government spending has started. So if you see, the government has been consistently spending double-digit growth in its spending, but in the last quarter they stepped it up to 16%. So as this government is able to sustain it, it's limited by the fiscal deficit and constraint, but at least the government is still spending is something which should cushion the economy. That's a good news. Second is that agricultural growth is already positive, but in the coming months, with the Kharif sowing, as I will show you some slides, has been good. So agricultural growth is going to go up even more in the coming months, right? So, and also that there are green shoots visible in a number of areas. So first is in terms of this whole NPA cycle. You have the moratoriums are coming to an end. So big worry was there. What's going to happen at the end of the moratorium? How the borrowers will be able to suddenly pay all of those 5 months EMI that didn't pay so long? RBI came out in this policy and very clearly then said that don't worry, we will not extend the moratorium, but at least we'll restructure the loans and give the banks enough flexibility to restructure. So they set up a Kamath committee who came up with this report, and as per that report, 66% of all the rated companies in India are going to benefit from this resolution framework, especially those which are already at a triple B and above. 71% of them will be benefit. Naturally, at the lower end, those who are already in PA will not be able to benefit. Which industries are likely to benefit? Construction, real estate, and chemicals are likely to be the key beneficiaries. So, in this way forward, one is the resolution framework, which is positive. Next is the rural India thing. We spoke about agriculture there. So, see this. In that agricultural growth was because of the Rabi crop, which was good. This is about the Kharif crop, which is just being sown. So from 5th January, we have tracked the sowing area. You can see it's fully risen to 100% of the normal area sown, and it's at a 7-year high. So you can expect a good agricultural harvest, and round about the Pongal Paisakhi period, you'll see all this food grain production coming and boosting up the GDP growth, agricultural GDP growth. Second, the lockdown caused migrant labor to go from urban to rural. So the government increased the NREGA payment to 40,000 crores, and that has led to a job demand being satisfied in the rural areas, partly by the government, partly by the Kharif sowing, a 40% YOY rise. Next is the fact that this money in the rural people's hand, they're feeling good about the Rabi harvest, meant that two-wheelers and passenger vehicles, which are largely demanded in rural, are the first showing signs of recovery. You can clearly see the V-shaped recovery happen. Right now, one thing which is that those two are still negative, mind you, but tractor sales with a V shape has actually moved into positive YOY growth because it's critically used in the sowing season. Right on urban India, the slowdown is still there. The recovery has started. It is not as sharp a V as the rural V. Right, there is gradual growth, and if you look at certain key indicators, traffic congestion, for a change, we welcome traffic congestion, that's going up. Then you see that TV advertisement, because people are working from home, spending a lot of time in front of the screens, TV ads have gone up. Government, I said, was spending, so their EVA bill procurement is showing a V-shaped recovery. Then you have freight. Now, across the board, the bulk commodities, cement, steel, coal, fertilizers, all are showing a positive. So overall freight is also showing a V-shaped recovery, right? And electricity consumption, good indicator of industrial growth as well as households using electricity, is showing a V-shaped growth. And to summarize, overall employment, even in urban area, is almost back to pre-COVID levels. Rural is definitely back there. So that's an indication. This is an inverted V which supports that argument. So there are green shoots indicating that in some time you can get back into a positive GDP growth territory. And Jeffrey's economic activity indicator, this puts together a lot of things together, says that we look to be just around 90% of pre-COVID levels in terms of economic activities, right? So our PMI, which is a good forecaster of the future, Purchase Manager Index of the PMI, tells you that a V-shaped recovery is on the way, but that's still at a level of 42, which means it's below 50. Only when you cross 50 will you say you are into a positive growth territory, which has happened for manufacturing, which has just touched 50. So the coming weeks, as it stays above 50, will give you a signal of growth coming back. So in short, there is an expectation of a V-shaped recovery. So in your overall scheme of things, there is a short to medium term expectation of a V-shaped recovery. What do you mean by that, and why do you have that kind of expectation? Apart from this, the government has the powerful tool of lockdown that has a negative economic impact but a positive containment of the infection impact. So that's a reason for the V-shaped expectation. The second is that vaccine or a cure. Every day you have news of some vaccines being tried out, something doing. So I think in a year's time, we'll have pretty much clarity. There will be a vaccine and a cure in place to tackle this crisis, which should give the economy a good booster. So on that basis, this is how the V-shaped recovery looks. To put it into numbers, the IMF came up with this a few months ago, saying that Indian economy this calendar year is expected to be negative growth of 4.5% for the full year. But for the next year itself, that is calendar year 22-21, they will be at 6% positive. So the V in terms of actual numbers is what it looks. So effectively, if you want to break this up into quarter-wise, this quarter you had a 24% negative, right? In the next quarter, you'll have a 9% negative. Then you'll have a 1.5% negative, and then you may have a 1.9% positive in January, February, March. So that is what is meant by a V-shaped recovery. So what it means is that in about 9 months from now is when you think that GDP growth will turn positive, and you can then expect that to happen. So how long will this take? This is what is our estimate, right? But that estimate is subject to certain risk factors not playing out. What are the risk factors? First is we contained it very well initially in the rural areas. So the initial breakup of the cases was 80% urban, 20% rural. But in the last 2 months, rural has gone up to 36 and to 47. In fact, the rural case rise at 7.4x is more than double the urban case rise at 3.3x. Right? So that's the risk factor. Why is this a risk? Three major things arise due to this. One, if a large portion of the rural population gets affected, the Kharif harvest, lack of labor can affect it. Number one. Second, if a significant portion of people there are affected, the consumer sentiment, because Diwali is when people are expecting the jump back in growth, will get delayed because that sentiment around Diwali will not be great if every member in your family, or at least one member in your family has got the crisis, or your neighbors have got it, the move to spend will not be there. And the third major risk is that if this goes really fast, then governments may reintroduce lockdowns, which may help in containing the virus, but will damage the economy further. So please keep track of the rate at which these rural cases are rising, right? And another thing, right? I talked about lots of signs of normalization, two-wheelers, cars, and tractors, but two key segments of the automotive industry, that is trucks and buses and three-wheelers, are at way below as a percentage of last year. Trucks are only at 17% and three-wheelers at 39%. So they are core part of economy, and for a real V-shaped recovery to play out, the demand for trucks and buses and three-wheelers also has to match with the recovery of the other segments. And then when you come to the retail selling part, right? Pan-India, North, East, West, South, if you see, though there is a sign of recovery, business is still 52% lower in August compared to last August. So that's the warning signal there. So based on this, right, let's now look at the stock market. So you can see that earnings is not going to be great immediate, but there is a chance of a V-shaped outlook in the future. So now when you look at it as a cap curve and look at our large cap space, FII flows, right? And I talked about this before. So FII flows, the reason that it turned favorable and expected to continue that way is that the expectation of the V-shaped recovery in large caps, because people expect large caps to recover much earlier than mid caps and small caps, is that next year, that is 21-22, after 4 years of 450 as an average EPS for the Nifty, the next year we are expecting it 664. So this sharp jump in the earnings of large cap companies is a strong indicator that FII flows which have come in, have expected this, and will continue to come in, right? The next is the reason for FII flows to be favorable to India is our valuation comparison, interstate with the rest of the world and LTA with our own past. So if you look at it, right, emerging markets as a whole are at most lowest valuations compared to US, Europe, or Japan. And within that, if you look at the valuation of India versus the emerging market, which is the green line on top, and India versus the world, which is the blue line on top, and the black line is your long-term average. So as you can see, India has always traded at a premium to emerging market and a much lesser premium to the world, but still mostly at a premium. What happened 2 years ago with our slowdown was that this premium started getting corrected. It came corrected till it reached the bottom in the March period. That's when people realized, oh, it's overcorrected because India's medium-term potential is still great. And then FIIs felt that the India was a good value buy and started putting money, and that started coming up. But it's still, as I've circled, it's still not reached the previous high. So India still remains a relatively attractive market on a inter-say basis and in long-term average basis, because our own long-term average premium, right, is being higher than this, right? So this is what the valuation story is telling you, that large caps in their valuation from December 17 are today at 1.3 higher, whereas mid caps and small caps are 7.5 and 3.2 lower. So indication is that future EPS growth of large caps is expected to be much better than the mid caps and the small caps in the initial part of the rally, because the forward PE is 1 year from today, right? So FI outlook will remain favorable to India, but for another reason also. So this, what I talked about, is all about FI22. That is, they will recover faster than the mid and small caps from an economic V-shaped recovery happening, right? But all FIIs don't look only at 22. There are FIIs like pension funds who look 10 years from now, sovereign wealth funds who look at it at 25 years from now. So they also invest now because of the correction, because they think India will bounce back as an economy on a much stronger and much more sustainable basis. What is the thought process of this? Is that India shares strong structural advantages vis-a-vis China, right? Where does this come from? Comes from the decline in the labor. The red line is the Chinese labor. As you can see, after rising right from the 1950s, 2017, it plateaued and started coming down. Whereas India is on the rising trend till 2050. So this plateauing going down means that China in the next 10 years, 17 to 27, is losing 21 million people from their workforce, whereas India is adding 115 million to the workforce. Next is that because of our education system and engineering and medicine and pharma and everything, we have more than adequate labor compared to our competition in basic, moderate, and advanced levels. And another supporting this is that China's per capita GDP is at $10,000, India is at $2,000. So Chinese labor is 5 times more costly than Indian labor. So India has abundant labor, abundant cheap labor, and the COVID crisis has made foreign manufacturers sitting in China increase their intention to move their factories out of China. 44% say it's increased their intention to relocate. So as a result of this, even China's manufacturers are likely to look outside to combat the lack of labor and the higher cost. So Vietnam is their first choice. So 1/3 of the potential $450 billion export moving out, Vietnam is poised to grab, but India is at second point with 69 billion. And in the coming days, we expect this to go up because FDI has been rising in India for quite a long time because of India's attractiveness. But it's mostly been coming into Paytm, Zomato, Swiggy, and the internet kind of startups. We need to make that come into manufacturing, and we need to increase also what is coming. So government has taken a number of initiatives to garner more FDI. For example, cutting the tax rates from 35 to 17 to make it at par with the best in the world. So which is Singapore. All other countries are costlier than us. On top of it, we also removed our dividend distribution tax because that was a tax on the income. FDI companies will try to repatriate back to their country. So making it unattractive, so they removed it. Similarly, they've given 100% tax income to SWF, sovereign wealth funds, for interest, dividend, and capital gains. So government is doing a lot to promote FDI and FII flows. At the same time, the work on the GST, the infrastructure, the licensing, the opening up the limits for FDI, and the finally the opening up of the public sector to the private sector, all have made India's ranking on the ease of doing business, EODB, jump 179 ranks over the last 5 years. So a manufacturer who looked at India 5 years ago to looking at it now is a huge difference. It's a big positive for India, right? And I talked about the fact that we need to change the quality of the FDI into manufacturing. Just one sector I will take to tell you how serious the government is and willing to take strong action to get business in. So this is called the PLI scheme, Production Linked Incentive Scheme. Government has launched a $7 billion plan. What is that? They are promising 4 to 6% on incremental sales for 5 years as an incentive to companies which come and set up manufacturing in India. The scheme closed on 22nd, 31st of July. 22 companies have filed applications. And who are these? These are all suppliers of Samsung and Apple. So Apple is 37% and Samsung 22% of the world mobile market. So 60% of the world mobile market manufacturing is going to shift to India, which means about 11 lakh crore of mobile phone and components will get produced and about 12 lakh jobs will get created. Just one example to tell you what the government is willing to do, needs to do in a whole host of sectors to get more FDI in. But foreigners are confident of this because this financial attractiveness plus people skills and availability and the business environment put together mean that India has become one of the most attractive countries globally for manufacturing. Come here. So as a result of which, India is well on the way to becoming the third largest economy in the world by 2024. And in 2008, we were nowhere in the top 10. So this is what foreigners are seeing about India. So both the FDI flow and the FII flow, which is directed towards the large caps, is on a very good wicket, provided liquidity is available. And is liquidity available and likely to be available? Absolutely, because one of the globe's response to the corona crisis was rate cuts and note printing and fiscal stimulus. Rates went from 2% global weighted average to 0.2%, almost a 90% drop in interest rates. Plus, look at the way the G4 countries have expanded the balance sheet. That notes printing that I was talking about, they've already done it by 30% of their balance sheet. And a lot of this money has moved into cash. Right? So it's ready to be invested wherever they see the return. How much? $3.5 trillion, of which we estimate that about $2 trillion is ready to move into the equities market, which is where India's space comes in their FII. And on top of it, over the next 12 to 15 months, another $13 trillion is likely to be the stimulus from central banks of the G4 countries. So ample liquidity, cheap money is going to be continuously available. So not only is the outlook favorable, there is likely to be sustainable liquidity for the large cap space in India. And further to it, though domestic MF sold 16,000 crores of equities during this period, their AUM also has a bias towards large cap. So if FIIs for short periods are selling, 68% of domestic MF equity in 10 lakh crores, 6.5 lakh crores is in large cap stocks. So there is ample liquidity to support the large caps in case the FIIs sell for short periods of time. Right? So this bias towards large caps by the thing is likely, according to me, to increase because of the multi-cap guidelines, which is a contrarian view to what the market expected when these guidelines were announced. Let me explain myself here, right? So the circular and multi-caps basically said that essentially they were treated by the industry as go anywhere funds, right? And fund managers chose to put 70% in large caps, 20 in mid and small in 10. What the government has changed, so it was essentially a low volatile segment with 70% large cap. What regulator said, be true to label. If you are multi-cap, put 25, 25, 25 in each. And so immediately those who adopt that, this category will become a higher volatility category. So the expectation immediately was that this didn't say become riskier, is that about 41,200 crores was on a simple piece of paper calculation that large caps have to be sold and mid and small caps have to be bought. And there was a rally in mid and small cap, and people were saying, oh, this is what is going to happen. But sad but true is the fact that this is not going to happen. Why? First of all, the AMCs have gone back to SEBI with their case, and that's being discussed. right? Second, so some kind of a solution will come from that. Number one. Number two, even otherwise, what will they do? They will either because their view is clearly that I need to be in large cap today. So they will either they'll recategorize their multi-cap funds into large or large and mid cap if they are not already present there. If they're already present there, they will evaluate merging the multi-cap into one of those two segments so that they can remain true to their thought process that today 70% has to be in large cap. Then thirdly, they will encourage their investors and the distributors to switch from their multi-cap to the large cap. So all of these three things, if they happen, means there's no need to sell large caps and buy mid and small caps, by and large, right? So no action will happen. Only those AMCs which don't do any of this and leave it as multi-caps, they may need to sell some large caps and buy some mid and small caps. This is the AMC's actions I expect. What will the investors be doing? Right? It depends on what the investor's risk profile is. If he chose it for a low risk, low reward, because it's a 70% large cap, then he will shift to large cap now. That's what he should do because he wants low risk. If he chose it for moderate risk, no, I'm comfortable with about 30% is there in mid and small cap, I'm comfortable, then there is a large and mid cap category, which is ideally suited because it has minimum 35% large cap, minimum 35% mid cap. So 65-35 is what it is likely to be and is being run down right like that. They will switch into that. And if they had chosen it for the flexibility, oh, today is 70% large cap, tomorrow it could be 70% mid and small. If you feel that flexibility is necessary, then now you have no choice but to do it yourself because the new multi-cap doesn't have the flexibility. So you'll have to change it. What you'll have to do, you'll have to take out the money, put it into large cap, whatever you feel, mid cap, whatever you feel, small cap, and change it in the future. That is if you chose it for that. But otherwise, if you say, no, I'm comfortable with high risk, then you do nothing. So if you see as a summary of this slide, I don't expect any significant selling in large caps, nor any huge buying in mid and small cap, though the people who are holding those stocks are holding on today, expecting this buying, and hence the liquidity has tightened and you're seeing a spike there. But according to me, this is not going to lead to any significant, huge jump in the demand for those. Right. So that being said, like I said, there's going to be FII flows into large caps, and MFs also have the enough liquidity in large caps to support it. So the outlook is that there's enough money for large caps, and you have seen the economic outlook. So now, when you get to choose, I have to come now and suggest to you what to do, right? So in that context, right, first you need to look inward because the type of investor will also decide the type of the mix. So first you decide your goals and then you come up with a financial plan, ideally with the help of an advisor. Next, you judge your risk appetite. Again, an advisor will be helpful to you here. What is it? A simple session. Don't overcomplicate it. 5-stage ranking, 10-stage ranking of your risk. Just put yourself into either aggressive, moderate, or conservative. And it's easy to judge this because it's your genetic makeup. If your parents and grandparents are very conservative, you will also be like that. It depends on your dependencies. Lots of your aged parents and your children, very young children there, you'll be less risk oriented, right? So these are all things, and your temperament, basic temperament. So just to classify, after which, don't put all your eggs in one basket. No, all in large cap, all in mid cap, or no. Because as I showed you right at the beginning, there's a wide variance in returns across time. So what you should do in consultation with an advisor, I would suggest you diversify across Capco specific mutual funds, and then you keep regularly evaluating based on the business cycle. So based on today's business cycle, what I would suggest is that look at the rolling returns to judge the risk-taking capacity because the past analysis has a predictive capacity for future. So the same set of data that I talked at the beginning of the presentation, I have now looked at it from a probability perspective. So what is the probability of the risk of capital loss? In large caps for 3 years, I will discuss, you can look at the rest as I speak. 7% is your risk of loss, which is 93% of the time your capital got protected, 7% loss, but it's 4 times higher for small cap, right? So when I take you through the allocation, this is what will come into play. But ability to take that risk 1/4 of the time on a 3-year investment, small caps are likely to lose your capital 1/5 of the time in a 5-year period. Go to 10 years, it's all hunky-dory. That's fine. Now, that's the risk part. But the reward part also you need to be aware of, right? Because when you take risk, you would like to compensate with that reward. So now you look at the reward. So what is the first reward, the benchmark? Protecting capital is not a reward. The first reward is you beat inflation, because generally bank deposit rates are also hovering around inflation. So today it's slightly different. Inflation 4.5, banks at 6, whatever. But post-tax is again at 4.5, right? Banks. So if you look at it, the reward of beating inflation, and here I've used a higher bar, I used 7%, right? Because long term, let us not look at a very low inflation. So if you see here, 70% of the time, large caps are giving you inflation beating returns, but only 53% of the time, a small cap giving you. So that is the extent of variability, right? And when you take the bar a bit higher, and you look at it as a double-digit return, and I want, no, not 7%, I want 10%. Then again, you see at around the double digit, they are broadly in the same pattern, 54, 64, 49. And whereas if you go to 15%, saying no, equity markets should deliver the super returns, 1/4 of the time here and 44 and 37. So as you can see here, clearly large caps have the lowest probability of capital loss, but they give you comparable high return probability. So that's one point, that if you're conservative, aggressive, this can be a good way to choose. So on that basis, right, clearly large caps are suited to those who need capital appreciation over the medium to long term with a lower volatility. I hope that point was made. So now you should, based on your risk profile, you should be easily able to judge that if you are an aggressive investor, I would say in today's circumstance, you should have a 5-year horizon. But like I said, the V-shaped recovery imparts the need to be flexible, is that you start with a 50% large cap and a 50% mid and small. And maybe a year later, once you have seen the V-shaped recovery happen, you can reduce the large caps and increase the mid and small cap. So this is for an aggressive investor. If you are less aggressive, you are a moderate person, then I would say you put 70% into large caps and 20 and 10 into mid and small caps. And if you are a conservative investor, then I would suggest you eschew small caps and put 80% into large caps and 20% into mid caps. Maybe a year later, you can add 10% into the small caps once the recovery is visible. So on this basis, as you can see, especially for the next 1 year, the portfolio should have a bias towards large cap with the flexibility alter, the reason being the current state of the business cycle, right? In fact, even if the expectation of business cycle changes, large caps can still form the core part of your portfolio at all times. So by mistake, you take a higher large cap and you're delayed in changing over. What happens to you? You look at it that over 15 years and 10 years, if you stayed in the large cap, you got point to point based on today 11% per annum, which compares very healthily with inflation and bank deposits, and you have the added tax advantage of equity of 10% versus 20% and 30% on other alternative bank deposits and other deposits, right? But this is point to point today. What if you did a rolling return so that you saw over a longer period of time what happens? So I've done this both for the Nifty 100, which is the benchmark for our fund, and Nifty 50. And as you can see, on an average, you have got double-digit returns, 3 years, 5 years, 10 years, Nifty or 50, 100. So large cap should form a core part of the portfolio, because for the safety, you are not giving up that much of a return, right? You're still getting, compared to your alternatives, better returns, right? Only if your aim and ambition is to get 15% plus return, do mid and small caps really form a part. And so they should be that portion which, based on your risk-taking capacity, they should increase the mid and small cap component, right? So the risk-reward equation, which is whatever, that was only returns I looked at, no? So I wanted to point out from a risk-reward. So look at this now. So in the large cap, right, the maximum, that's the reward, right? The maximum returns, I thought average was 12, but if your timing was very good, the reward you get is 48% per annum on 3 years, 25% per annum on 5 years, and 18% per annum on 10 years. So like I said, if the timing is good, that is in that 10-year period, you've made fabulous returns. But what is the probability of beating inflation? That was maximum. Let's look at it from a risk reward probability. So you see that 68 to 70% in 3 to 5 years, you are beating inflation, right? But in 10 years, that becomes 90%. So in large caps, if you stay for 10 years, Your maximum return is 18, your average is 12, and 90% of the time you're assured of beating inflation. What more do you want from an equity asset, right? Because the risk part of it is also minimized, right? Because there's a low loss potential with low loss probabilities. What do I mean? Look at it, 3 years, 5 years, 10 years, right? In 3 years and 5 years, your minimum return, that is what if there was a loss, how deep was the loss? It's only 6.8% per annum in 3 years. And if you stayed 5 years, it's only 2.3% per annum, the worst case scenario. And 10 years, all that gets wiped, you get minimum 3.8% return, better than your savings bank account. And the probability of that loss happening, right? Clearly, 10 years it's zero, right? Because the minimum is positive. But if you take 3 years and 5 years, what are you seeing? You are saying that your 5% is only the probability of getting that 6% negative. You're at the margins, right? Because what effectively you're saying is that 95% of the time I don't have a loss of capital. And it's even less in you go to 5 years. It's only 1.5% probability of loss. So clearly, large caps have to form a core part of your portfolio at any time. The timing now is even better because of the situation of the economy, and hence we are launching our NFO at this time, right? September 17th to 30th. And I have spoken enough about large caps as a sector using the indices. Now I want to move to the fund management side, where why is a fund manager expected to deliver better returns than index? Because stock picking matters even in large caps. What do I mean by that? That if you put 100 rupees in the Nifty 100 in 2009, in 10 years it has grown to 240. But there are out of the 100 stocks in the Nifty 100, there are 46 stocks which have consistently been in the index. That means that quality has been such that their market cap is been in the top 100, right? Balance 54, sometimes inside, sometimes outside. So these 46, if a good fund manager had picked them, you would have got for your 100 rupees 289, which is 49 rupees more, which means 49 divided by 100, 49% more absolute return, right? So that's why stock picking matters and why a fund manager is expected to deliver, right? Which are the kind of companies those stocks are, and few are given here, all are household names, right? And so Sundaram, in this fund, how are we going to do stock picking? Through our own diligent and disciplined investment process that is laid out here. And for this, we have chosen what is called as a blue chip quality framework. What is that? It's a non-stock market framework. It is based on the business. So first, what does it say? Is management quality. It is capable, credible management with strong corporate governance. One. Second, business model quality. What is that? Strong competitive positioning and strong competitive advantage. Process and system which come with scale and size, because most small cap and mid caps are owner driven. So they don't have the systems and processes to do. And then a brand value which has seen many business cycles, so that the company knows how to handle a bad time, how to handle a good time. And then on financial quality, we talk about attractive return on equities, we talk about cash profits and not paper profits, and we talk about company reinvesting that cash into the business so that they borrow less. So the healthy balance sheet means that their debt equity ratio is very healthy, low debt, high equity. So these are the three blue chip qualities. Now, these three blue chip qualities are non-stock market. Does the stock market respect this blue chip quality at all? Because you may say good company, but is it good from a market perspective? So what I did here, what we have done is that there are 35 large cap funds in the industry. Only 7 have chosen to name themselves as blue chip funds. Now I accept that Sundaram's idea of blue chip fund and another AMC's idea of blue chip fund could be very different. But both of us, you have to agree, is that by naming it blue chip, we are seeking to have a quality portfolio. The way they define quality may be different from the way I define quality. But ultimately, quality is our aim. So I have now looked at those 7 funds and seen their returns, which is what I call the blue chip category average. Then I've taken the whole large cap category average, and I've taken the BSE 100 average. And if you can see that these funds collectively have beaten the blue chip, the category average, and have beaten the index. Which means what? The conclusion I want to drive from this is that the stock market respects quality. Right? So whatever be the filter you use, the chances are likely that quality filter will lead the market to respect it and give you better returns. So that's the blue chip thing that I spoke about. And if you look at our funds, right, we have also got certain long-term picks. I've picked those picks in the overall portfolio of a fund, which have been in the fund or one specific fund I've chosen. At least for 4 years, they have remained in the fund. So they are long term. And I've taken a 5.5 year period from March 2015. So you can see that the weightages of these, what is the beginning and what is the end. In most cases, we have increased the weightages. And if you see that these stocks, 4 of the 8 stocks are given strong double-digit returns. 3 of them have given high single-digit returns. Only one of them is LLT, because it's an industrial pick, which is the business cyclicality affects it, is given a slightly negative return. So this is the way Sundaram Mutual has picked stocks in one of our funds, right? And I want to now take you through 3 case studies of stocks we bought, which are blue chips. And I want to tell you how we will select blue chips. And they are currently in our fund. So, Tata Consumer Products, a result of a merger of Tata Tea, Tata Salt, Tata Coffee, a mega Tata brand company, carries the strength of the Tata brand and is a huge player in multiple consumer spaces, right? So, such a company, we bought it in 2017. And if you see, its sales went from 6,700 crores to 10,700 crores, and next year is expected to be 11,500. In that period, his EPS has gone from 6 to 8. Next year is expected to be double at 12. So such a company, right? Because it's a blue chip, right? Its PE ratio is high. So look at it, 90. But what is the PE? I spoke about it a few minutes ago, right? The PE comes from a demand for the stock, which means it's very attractive for people to buy, but also an expectation of future earnings. Now we started at a P of 90, today it's a P of 66. What does that tell you? That the concerned company has consistently beaten the return expectation of the market analysts and deliver better. That's why the PE has come down. So next year is down to 47. So that's why I said even at a high PE. So blue chips are high PE for your information, but as long as you pick the right company, which is going to deliver better than expectations, you can see that since the day we invested, the Nifty 100 has gone up by 7.1% per annum, but this stock has gone up 42.6% per annum. Right? So I rest my case on this company. Next is Bharti Airtel. Slightly controversial because Jio is fighting with it. Who will win the race is a big question mark and all of that. But please remember one thing. That he is a survivor, he's a dedicated telecom player, and thanks to the butchery of the rest of the industry, it's now become effectively a duopoly. There's a third Vodafone in the anvil, but it's effectively a duopoly, and India is a large and probably the fastest growing market in the world. So as a duopoly, both the companies will benefit from this advantage, and such a company, it has been through its ups and downs in terms of revenues and EBITDA, but if you look at its EBITDA margin, he has maintained that solidly at 36 to 40%, right? So that kind of a company, by buying it, we have enjoyed a 17.9% per annum return as compared to the index is 7.1, and we feel that the coming days of this company are going to be even better. That's why the ratios are still high, right? The third case study I want to showcase to you, friends, is SBI Life Insurance. Strong brand parentage of SBI, unparalleled bank network of 20,000 branches, already the largest private player having 23% share, and is the next LIC in the making. Such a company, we bought it in 2017, has doubled its enterprise value, the substitute for sales, right? From 190 to 402 expected next year. Its EPS has gone from 11.5 to 19, expected to go to double next year. And it's again another company where the PE ratio was 75 when you bought it. But again, now from 75 has come to 43 and headed to 37, means that company has consistently beaten the analyst expectation of earnings, and hence such a company has delivered triple the return of the index. Index has delivered 3.6. This company has delivered 10.1% to our portfolio per annum. So those three case studies hopefully have shown you the way we will be choosing the blue chips in our portfolio. And if you look at it from a sector perspective, I spoke a lot on the stocks. The sector, we are going to be sector agnostic. And if you see from 2007 to now, and you look at the red being the negative sectors, the green the positive, the leadership has kept changing. So no point in keeping a very permanent sectoral approach. Constant flexibility is needed. In fact, over the last 3 years, as a company, our sector calls, you see, have changed year over year on the overweights and the underweights in the industry. So sector, we have to be agnostic, be smart and ready to change. And now I just quickly take you to the fact of Sundaram's large cap track record in terms of the funds being going to be managed by the fund manager of this fund, who's our primarily large cap fund manager. The four funds that he manages in the open-ended space all carry in the first green table 58 to 90% large caps. So he is an experienced large cap fund manager. Select Focus is one of the funds he manages, but since it's also large cap, it's my duty to explain what's different from Focus to Bluechip. Focus is a concentrated large cap with 30 stocks. Bluechip has 45 to 50 stocks. The other aspects of it, I will tell you, is that the concentration within the 30 is very high, with top 10 stocks forming 60%, whereas here top 10 will be 40 to 45%. Second is vis-a-vis the benchmark, which is Nifty 50. He takes quite a few high conviction bets in Focus, but here he will not take such a wide range. He will be closer to the benchmark in terms of that. So if you see here, those same points I wanted to demonstrate to you is that his top 10 stocks have been consistent since the April to June quarter 2018, when SEBI categorized large cap funds, has been consistently in the 55 to 65, 10 stocks. In fact, 3 stocks have been 27%. So Focus is a high conviction, super concentration, super flexible fund, whereas, right, and the overlap also, if you see, sector-wise, he has maintained in the middle a high 80% overlap with the benchmark sectors, but in the stock, he's maintained only a 60% overlap. Means 40% of the stock by weight he has chosen from outside of the benchmark, right? So that will not be the case in this fund because it's a diversified fund. He also manages a diversified large cap fund. Just in case you said, no, he's good at managing concentrated, does he manage diversified? Yes. In the equity hybrid, the old balanced fund, he has a 75% large cap of the equity portfolio, and he has 48 stocks, right? And the top 10 stocks are just 45%, very close to what the blue chip fund is likely to have, right? The final fund of Rahul Bajaj that I want to tell you is the new NFO 2 years back that he launched, the services fund, which has also got 59% large caps. And if you see that, he deployed the money in the second half of that year gradually over a period. So to the extent that the regulations allow, he will do the same in this fund to stagger the deployment, because in the next few months, we expect the market to remain volatile because of the US elections. The table, the slide here shows you right from the 2000 elections. The 3 months before the elections, markets have corrected, the US stock market, because people have pulled their money out of equities. And same thing, FIIs in India and other emerging countries will also be trying to pull their money out in this period. But 3 months, 6 months after, it bounces back. So that given that volatility which will come to our market, because not just this, the rural COVID case rise I spoke about, and put together, we expect a volatile period. So we will stagger the deployment within the regulations to the extent possible to maximize, because he will be sitting with the most powerful thing in the world, cash on hand from the NFO collections. So that, to summarize the fund, dear friends, is that it's going to be a diversified, the bedrock of the fund is that diversified in terms of number of stocks, concentration, risk, all of that. Blue chip quality framework, and it will be a blend of growth and value. So it's not just going to be just high P ratio growth oriented stocks, but he will also pick value stocks which will come in from the sectoral allocation, because as you know, certain sectors are expected to be later recovery and certain other sectors. So he will play the value game there till the value is reached and changed over. So the blend of growth and value will help him to reduce the risk portfolio, which is the purpose of a diversified large cap fund. So to summarize, right, This is the advertisement campaign based on a sumo wrestler. And the reason we chose a sumo, let me explain to you in 30 seconds. Right. So a sumo wrestler is big in size. So size matters comes through. But I could have chosen an elephant to show big in size. No. Why did you choose a sumo wrestler? Because in sumo wrestling, you have two big people trying to push each other off, right? So the first thing is, as this picture demonstrates, that sumo wrestler has to have the stability, a low center of gravity to take the pushback from the opponent. So one category or characteristic of blue chip large caps is their stability across business cycles, which point comes through by the choice of a sumo wrestler. The second aspect is, if you've seen a sumo wrestling competition, or if you can see the video which comes on television and the YouTube and all other channels, right? You will observe in the course of that wrestling competition that we have used for presenting our fund is that one wrestler has to turn the other big wrestler down and push him down. He can do that only and only if he has got agility and flexibility on his side, which is another characteristic of blue chip large cap stocks. So we feel that a sumo wrestler represents all the three: size, stability, flexibility in one image, which effectively portrays what these stocks in our fund are going to demonstrate and going to be the reason for it to deliver the goal of capital appreciation with lesser volatility, right? So to summarize, it's an open-ended scheme investing in large caps. Nifty 100 is the benchmark. Rahul Bajal is the main fund manager. And like all equity funds, it has a 1-year exit load with a minimum investment of just 100 rupees. SIPs are also available. Thank you very much for listening to this presentation. And I'm happy to take any questions if there are around the fund or around any of the other things that I've discussed. Thank you.
Participants, if you have any questions, please post them on the chat. If you're watching us live on Facebook, YouTube, and Twitter, you can drop it in the comment section. So, should I start with the first question now?
Yes, please.
Oh, yeah. The first question, sir, is should be an ideal time to do a lump sum in Sundaram Blue Chip Fund?
Well, I think so too, because though generally SIPs are always a good form to invest, right? SIPs should generally be done when your income is coming monthly, right? That. But if you have a lump sum on hand, splitting it into SIP like installments and staggering is useful when you feel there is going to be volatility, which is the case now. But for your advantage, the NFO, as compared to an open-ended large cap existing fund, NFO has the ability to deploy your money in a staggered fashion into the market. So really, if you have a lump sum, please put it as a lump sum. You don't need to split it in the NFO. You can start an SIP if you want to coincide it with your salary income or rental income or pension or whatever.
So the next question, given the current market volatility, what will be the fund manager's strategy for the next 6 months?
Next 6 months is to stagger deployment. We have the ability to invest in arbitrage hedges for up to 50% of the portfolio. As you know, we have to maintain 65% to give equity taxation to the investors. So our initial approach would be to deploy the 15% and use the 50% to achieve the equity status. And the balance 35% we will stagger deploy, and then we'll dip into the 50% as when we feel that we have bought enough good quality stocks there in a correction, because that's what we are looking for. We know our portfolio, we're just waiting for the prices to correct so that we can buy low, so that we can sell high later.
The next question is, my client has invested in Select Focus for 5 years. Should I ask him to switch to Blue Chip?
If he's been there for 5 years and you chose it because you knew the concentrated portfolio and the high risk, high reward, and that customer was comfortable with that, there's no need to change. It depends on that. However, if you chose it as a large cap product and you find that it's volatile and you want a safer large cap product, you can ask him to switch to Blue Chip.
Would you recommend investing in mid and small caps now, or is Blue Chip an optimum?
So I would say that if you have a 3 to 5 year time frame, Bluechip is an optimal investment at this point in time, because the initial phase, right, the liquidity for large caps will be abundant. Economic recovery will show itself in the large cap before they show up in the mid and small cap. But when economic recovery really sets in, at that time, typically the lack of liquidity in mid caps and the earnings growth being faster, then they tend to rise at a later part of the when the virtuous cycle sets in. So if you have a 5 year plus approach in your life and you can put some allocation to mid and small cap, I would recommend that you do it through the SIP or the STP route in mid and small caps.
The next question, sir. The market's been falling for the last 2 days, yesterday and today. So, do you think we're seeing another fall like the one we saw in April, or is this just temporary?
Well, you can see the broad smile on my face, right? Because that's good news for our NFO, because good quality companies are going to be available to us at reasonable prices. So while I don't wish for the volatility to continue, the fact is that I would say that the volatility will be there till the US elections and the result, how they throw it up. Because as you know, Mr. Biden has very opposite views to Mr. Trump. And so the markets will also factor that in, and there will be volatility. Other reason for the volatility I told you is the rural case rise. The third reason would be that normally in December, the fund managers of hedge funds book profits because they need to pay bonuses and all of that. So generally, it's a last quarter of the year is a bit volatile. So the lessons of a correction, however, I don't believe will be as strong as the one in March at that period, because I think there it was a case of the sudden black swan event of a COVID crisis catching the market unawares suddenly with the intensity of its crisis. Whereas now it's a known event. So there will be the traditional volatility, but it's not going to be a very deep, sharp correction. The other reason being that any such sell-off in a big way by FIIs, domestic mutual funds, who have been selling in this period when FIIs are buying, have got enough cash in them to buy. So there will be support. And Sundaram with his NFO collections will be a big supporter of the large cap space in the market. So we will help reduce the downward volatility in the whatever correction happens.
The next question, sir. Should we be looking at gold now?
You should always be looking at gold, because gold has a place. What is gold's place? Gold's place is an umbrella. So when you step out of the house, right, you don't know whether it's going to be rain or it's going to be so hot. So the umbrella gives you protection from the extremes, right? So the same way gold gives you protection from a hyperinflation, from a war threat or a COVID threat. So one doesn't know when that is going to happen. So you always keep a little bit of gold, because that will be your fallback option, right, to cover up the losses. So, but you shouldn't overdo it, because gold is that one asset class which doesn't have any earnings to justify its future price rise. It's pure demand and supply. You saw the framework that I put up: EPS growth, future EPS growth, and demand supply for that commodity or stock or whatever. So both EPS growth and future EPS growth are non-existent. Gold essentially is a traded commodity. So when traders go into it, you'll make money. When traders pull out, you lose money. So what I would suggest is that you take a 5 to 15% as a max exposure to gold. So 5% if you're very aggressive as an investor, 15% if you're very conservative as an investor is a fallback to your thing. It should be a regular part of your portfolio at around that 5 to 15%, because there are times when it will look fantastic and times when it will look very dejected, but you shouldn't be selling when you're dejected and buying when you're euphoric. Just keep it a constant 5 to 15% range in your portfolio.
The next question, sir. HSBC shares sink to a 22-year low in Hong Kong, and Stan Chart sags over dirty money scandal. What are your views on this? What's the issue going on and the impact on the financial sector?
I think that this is more to do with the money laundering and the international kind of a thing. I think Indian banks are well protected. I think they're very well regulated by RBI, and I don't expect this to have any contagion effect on the Indian banking sector. Indian banking sector has its own challenges in terms of the moratorium, the NPAs and all of that, but I believe that it is coming out of that phase with the RBI's restructuring, and when a V-shaped recovery occurs, Indian banks with cheap money and lots of money, because RBI has stuffed money down their throat, about 6 lakh crores of liquidity, are ideally poised to benefit from the V-shaped recovery much better. So I believe that this, what you mentioned about Hong Kong Bank and Stand Chart, is not likely to affect. Sentimentally, those stocks will get corrected, but it's a good time to buy them because their fundamental business model and proposition in India, I believe, is very good.
The last question, sir. If you had to convince someone to buy Sundaram Bluechip fund in one line or less, in one line, what would you tell them?
Large caps have given from 3 to 10 years an average return of 10 to 12% per annum. In the 3 years time frame to 5 years time frame, your chances of losing your capital are less than 5%, but your chances of getting good maximum index inflation beating returns, our probability is very high. So I think as a customer who wants lesser volatility but a good probability of getting inflation beating returns, Sundaram Bluechip Fund is your best bet in today's economic and market scenario. They're a very long sentence, but it's all in one sentence.
Well said, sir. That's it, sir, for today.
Thank you. Thank you, friends, for patiently listening. This video will be available on YouTube and other social media things for you to see it again if you want to go through some of the slides and understand them better. And do spread the word among your friends about this fund and about the presentation. You can share with them, ask them to look at it, to get more understanding. And we've also made very digitally friendly in terms of your access. You see the pad and the paper, you click a camera link, the QR code takes you to our website. You click on any other link which was sent to you by your advisor, distributor, or any other. You have a simple click-through process provided you do your KYC. So I think even the SIPs through digital mode, through eNACH have been facilitated on our website. So please do take advantage of that and do make an investment in this fund. Thank you very, very much and happy investing and stay